Howdy, Jacob here. Today we're looking at Darling Ingredients, 6.6 billion market cap, 10.8 billion enterprise value, quite a bit of net debt in the food and products industry. They produce and sell natural ingredients from edible and inedible bionutrients globally. Founded in 1882 out of Irvine, Texas. They have been around for quite some time here, and the growth is more impressive than I would have thought, but it's mainly due to the 2021 and 2022. Outside of that, from 2014 to 2020, they actually had a decline in revenue, but huge last 2 years of growth. And we actually do see growth as well on the operating and gross margin side. Return on invested capital recently is pretty decent, but historically averaging mid-single digits, so nothing to brag about. Balance sheet shows 127 million cash on hand with 4.3 billion long-term debt. Again, it looks like they made some big net acquisitions to grow that top line. And I mean, they did grow their bottom line a little bit as well, but that's absolutely what we see here. 2 billion net acquisition, 1.1 billion net acquisition, funded entirely through debt and a little bit of their excess free cash flow. Their other use of free cash flow is mostly share repurchases, but share repurchases represent a very abysmal portion of their free cash flow. Even if we average out the last 4 years, if this is their capital expenditures line, you're looking at about 300, 400, 400, 3. Okay, so let's say it averages about $350 million. About 30%, 30 to 40% is going to share repurchases, with the rest even more going towards acquisitions. Again, capital allocation gets a little wonky when you go into debt. So this is saying that over 100% of their free cash flow has been going towards acquisitions and 40% to share repurchases, but that's because they've been issuing 50%, 40% in debt for the last couple of years at least. And so when you try to make your assumptions on a free cash flow model, you have to take into consideration what the company's done in the past with what you want them to do. And for a company that has this much debt, I mean, we're talking generously $400 million in free cash flow a year, and they have $4.3 billion in long-term debt. So over 10 times their generous estimation of free cash flow. And so it's a lot of debt. I mean, a balance sheet can be enough to where it might turn me off immediately. I've thought about, or I definitely remember one investment at least that I've made into a company. I believe it was Ebix, and I got out, right before some terrible stuff happened at a huge decline. But either way, I bought them because the price of free cash flow on a free cash flow basis looked like an absolute steal. But they had a lot of short-term debt that was coming due, and problems occurred. And so obviously right now their debt, most of their debt, almost all their debt is in long-term debt, 61 million in short-term debt. They have more cash than that. But when debt comes due, you either have to refinance it or pay it. And when you're refinancing it, you're really just kicking the rock down the road. And that's fine if you have 1, 2, 3 years of your 5-year average free cash flow, just kicking it down. That's fine, because it's really just an extra way to fund projects beyond free cash flow. But when it gets excessive, like 10 times, that's easily going to be a problem, and that's going to hinder me from wanting to invest in them, and hopefully other people, as they learn that the balance sheet is an extremely important part of reviewing a company and investing in a business. And so let's get to making some assumptions here. These huge growths really just because of acquisitions. And so if we dampen their acquisition to 20 to 30% of capital allocation, I think that they can definitely grow with inflation, but they've been around so long, I don't think they can go much more than that. With their enterprise value so much greater than their market cap, I think I'm going to give them a dampened 12p in price to free cash flow, saying that they've been around for quite some time, but the debt that they've gone into recently really makes me a little bit worried. And I think that their terminal value, for that reason, even if they allocate 30 to 50% of capital allocation to debt reduction, which I don't think we'll see them do that, as historically, I guess they bond back 100 mil here, 172 mil here. It's just not enough to really make an impact on a $4 billion debt. And so maybe even lower. Let me put it at a 10p. And then for margins, they have been higher recently. So maybe those acquisitions did increase the efficiency of the business. Either way, it's not looking absolutely fantastic. So maybe we'll do 7 and 5. Again, earnings are a lot higher in free cash flow. Not something that I prefer. I definitely prefer the other way, since free cash flow is definitely harder to manipulate. Cash in, cash out. You can't really do much outside of maybe stock-based compensation. I mean, obviously depreciation and amortization a little bit, but you'd really have to have a lot of assets for that to make a difference. But either way, share change, I mean, we're already assuming 30 to 50% to debt reduction, about 30% to acquisition. That's leaving only about 20% of capital allocation, which is less than 100 million and 66 million to make a difference. 100 million there. So, okay, I'm fine with that. Nope, 14, 1%. All right, so this is with my current assumptions right now. It needs to fall 75% before you get the return I'm looking for here. To me, that balance sheet just is really irking me, and I don't think it's so obviously cheap. I'd want to do a deeper dive on it. But on to the next one.